Do interest rates ultimately matter for the price of real estate in 2022? What do you do about cash? Should you save it? Should you invest it? What is inflation doing to your savings account? What about price control? Is that a good idea? Should we begin to implement price control with rising prices? These are all the things that Dr. Peter Linneman in this video discussed, and I want to talk about some of my highlights, some of my big takeaways, and how I think it's going to impact us as real estate investors in 2022, and some of the decisions you might begin to consider over the next 3 to 6 months in the way you allocate your portfolio to really significantly build wealth over the next 5 to 8 years. I want to get in this video today. If you don't know who Dr. Peter Linneman is, make sure you check him out. He's an OG in this space, and for sure, I would recommend listening to this whole episode, but I'll break down the highlights for you here. So let's jump into the first part of this show. He has some pretty bold predictions I want to get into.
So Dow closed yesterday at 36,252. Where's the Dow on 12/31/22?
39-ish, up 8-10%.
10-year closed at 174 yesterday, has rallied a little bit today. Where is it at the end of the year?
2.6-ish, 2.5-ish.
The Fed will raise rates how many times in 2022?
They'll probably raise about 75 basis points, and therefore probably 3 times 25 bips per raise.
So ultimately, he's pretty bullish on the economy. He sees the Dow going up. However, he ends this little clip with thinking that interest rates also go up over the next year. 75 basis points, essentially rising 3 times to 25 basis points. The reason this is so important, especially if you're real estate investors, because most real estate investors would believe, and maybe historically the numbers might show out over a long period of time, that cap rates are correlated to interest rates. And so meaning as interest rates go up, cap rates in commercial real estate go up. And the cap rate is really ultimately determined of the value of real estate. So what we're saying is as interest rates go up, the value of the real estate is going to go down. And this is maybe a traditional thought in this space. However, you're going to see in this video, even though he thinks interest rates may go up, he has a much, much different outlook for where real estate prices are going to go. And so again, he sets this off in a really interesting way, and I'm excited to get more into this episode.
The consumer is missing is the massive strength of the U.S. economy. And I was reflecting on this the other day. What lesson did I take away from the last 22 months, let's say? What lesson I took away, and it took some reflection, is don't bet against the U.S. economy. And I've always said that. I'm not the first to say it. But think of it this way, Willie, and then we'll end with consumer confidence. We had horrible pandemic. We had massive premature deaths. By the way, we had record drug deaths on top of that. We had political turmoil. We had social turmoil. We had the January 6th phenomena that you described. I mean, you can just go on and on of all the challenges we had. And yet, 22 months later, from the beginning of, for us, the pandemic, real GDP is 1.5% higher, which is essentially flat per capita. Industrial output is essentially 99% of what it was pre-pandemic. And you kind of go, oh my God, with all that, we were able to do that. And I think what the consumer misses is this, just the sheer power of this economy that it overcomes. It doesn't overcome every minute, doesn't overcome it. We invented we invented and mass distributed 3 vaccines. I mean, just think about that in 22 months from just sheer brute power.
So I'm appreciative of this clip, mostly just because it gives me perspective. He's been around a long time. He's seen a lot of ups and downs in the U.S. economy. And then we've all kind of seen what's happened through COVID, the hit we took there. But ultimately, we recovered. We created 3 vaccines. Our GDP is up. It just shows that this is still the best economy in the world. It is the best country in the world to live in terms of growth, in terms of opportunity. And so it just makes me thankful and grateful to live in this country and to see what we as a people can overcome no matter the odds. And so this is really ultimately setting up his kind of outlook on 2022 and the next couple of years. So these next two clips are where this interview gets really interesting for me, and then what I think you're going to really enjoy, because we're going to start to hear his view on inflation and price control. We're hearing a lot in the media right now, inflation, price control, what should we do? And this is where I think his perspective and being a vet of 30, 40 years studying this economy, I'm going to show you this clip around price control. 1970s, he was able to kind of pull out an example of when Richard Nixon and President Ford did the same thing and its impact on the U.S. economy. So let's run that clip real quick, and then we're going to talk about inflation, rising interest rates, and what to do as investors.
The last thing we need are price controls. The inflation that's occurring, Willie, these high prices that are occurring are resulting from shortfalls in capacity. And the high prices are sending up flares saying, bring capacity here, bring capacity here, bring capacity here. What price controls would do is eliminate the signals of bring capacity here. And that would really harm the economy. That's what really could derail us this year. I hope it doesn't, but if it happens, it'll be a disaster.
So you can see his one fear, and this is where I would say he does kind of have one negative outlook on the economy, is all this talk about price control. His point was, if you say, hey, we're going to put price control on this area of the economy or on this goods and services, then you eliminate the demand, eliminate the incentive for new suppliers to want to come into that market. It's the same thing with rent control. Why would I want to go buy into a market where I'm capped on the amount of rent I can charge in the area? Why would I go invest money into that area if I'm not able to raise my prices and actually experience yield off of that investment? And so this is the real one negative outlook he has. And he says, if there's something in the economy that could derail us, it's if politicians essentially try and take over, and try and begin to manipulate on their own the U.S. economy. It's definitely something to pay attention to right now in the media. And if we can somehow have a sway in our vote and, talking to our politicians and our leaders in this country, let them know we do not want price control. Same thing with rent control. This is essentially a demotivator of creation in our economy, in his opinion and in my opinion. Now I want to get into, though, this is where we begin to shift into commercial real estate. There's a great clip he has about what inflation is doing in terms of real interest rates, and I think you're going to find this really fascinating. We'll come back.
Think of it this way, Willie. Go back, 15 years ago, Treasury was at 4.5, inflation was 2.5. I could get a 2% real return out of the box by buying a government bond. Now, it may end up worse or better depending on how inflation plays out, right? But at least I thought I had it. Today, what is it? I don't know what it is today, 1.7%. And inflation, even if you believe, as I do, that it normalizes back down to 2.5%, it's a negative real return. I don't have a fighting chance of making money. And in fact, if inflation is 7% this year, and I'm getting 1.7%, what is that? That's 5 years. 5 years of income just gone, right? In terms of trying to keep up with inflation, right? Just gone. My only chance of making a return is the last 3 years on the bond, if you will. So what is real estate given that world? And by the way, stocks given that world a fighting chance. At least I have a fighting chance. The investment I make in real estate may go wrong. I may lose money. I may not do great. I may do great. I at least have a fighting chance. You don't have a fighting chance in the bond market.
To recap what he's saying about real interest rates being negative, he's just saying this: if you place your money in the bond market, let's just fast forward today. If you place your cash in the bond market or in a savings account, right, and you're making, typically in both those places, you're making less than 1%. Currently, inflation index is at 7%. 6%, meaning your real interest rate, the amount of money that you're losing due to inflation and what you're growing in a bonds or savings account is literally has a negative 6% yield. So he says if you're just sitting in cash, you have no chance. His point is, well, with commercial real estate, we're finding yield right now. At least the investor has a fighting chance. And ultimately, and this is really where the rest of the video goes, which is why this has kind of had such a stir on this market or in the real estate industry, is because he's saying there is a ton of capital in the market right now. And ultimately, even though he thinks interest rates are going to go up over the next year, because there's this massive supply of money that must chase yield or else they're going to lose money, that the weight of money is going to ultimately lower cap rates and increase the value of commercial real estate. He uses the example to say if a year from now, if twice the amount of money is invested into commercial real estate, what is the price of commercial real estate going to do? Well, it's a no-brainer. It's going to go up. And so he makes the argument, and it's something I think we all should wrestle with, is that if there is a greater demand for a product like commercial real estate, what should we do? Well, we know we can't sit in cash because we're going to lose money. We should place our money in appreciating cash flowing assets that do create yield. And so ultimately, his sentiment, along with mine and many of my colleagues, is that we want to get our money into these type of assets. Now is a great time to be investing in commercial real estate. But for those of you who are still skeptical, like I am and was a lot more before I watched this, think, well, how long can this go? And I think that is definitely what I'm seeing with a lot of people who've been in this space for a long time. They have a price bias, meaning they were buying units in Dallas at $100,000 and now they're over $200,000 a unit. They're saying, I can't justify the price of $200K when I was buying for $100K, not realizing how much more capital there is for a diminishing amount of supply. And so this last clip, I think, shares that. I think is going to be really helpful for you to see. So let's check this out before we end this episode.
Send that message home to your readers. You write, despite the historical precedent to the contrary, we also expect a second decade of buyers thinking, quote, surely cap rates will go up, unquote, even as they compress.
Yeah. And by the way, I was one of those people a decade ago, right? Who was saying, can't last, can't last. And it kept lasting, right? Cap rates kept coming down, cap rates kept coming down. And I started going, what's going on? And I really started looking at the data. I really started thinking about it. And I realized, just take, for example, I know you know this, in 2007, cap rates were essentially the same as in 2019, right? Just as roughly, right? And yet in 2007, interest rates were above 5%, both on the long and the short. And in 2019, they were both basically below 3%, right? Well, if interest rates are determining cap rates, how did that occur?
Right.
Well, what did they have in common? It wasn't interest rates. What they had in common was a lot of money chasing, a lot of money chasing. I don't mean that in a bad sense. If money is put in the system, it chases. And so and I am a Milton Friedman student. And so when you put in a lot of money, whatever it chases will go up a lot in price. And what it chased in the 70s tended to be goods and services and assets. Okay, goods and services and assets. What it chased in the 2013 to 2019, and I think will chase again, is assets and goods and services.
Let me end by saying this. Ultimately, I am bullish, like Dr. Linneman, on commercial real estate and commercial real estate prices. However, I think it's so important for any investor to know that when you're investing in real estate, you're not investing in real estate because you think the price of real estate is ultimately going to go up. You invest in real estate because you find ways to add value to that asset, increasing the cash flow, decreasing expenses, for example, and therefore you can increase the value of your real estate. However, on top of that, if you can do that on top of investing in an appreciating market, a fast-growing market, a market where there's a ton of demand for, then that's much, much better, clearly. Dr. Peter Linneman's sentiment that for those who know how to create value in real estate and can take advantage of the next 5 to 7 years are going to do very, very well. much better than those who just sit in cash and kind of wait or hope for the next downturn. I hope that's not you. Be sure to think wealthy. Subscribe, like this channel, follow me for great content like this. Cheers.